Welcome to the Dividend Talk Podcast, episode 138, an interview with Ian Lopuch. Hey guys, Ian joins us once again on Dividend Talk to talk all things dividend investing. In this episode, we talk about his new portfolio, we talk a little bit about crypto and alternative assets. He also talks a little bit about financial independence and what it means to him. You can also expect to hear some of the famous tickers, including Altria, Home Depot, and lots more. As always, feel free to check us out on Twitter and Facebook, and you can find us on all podcast platforms. See you on the inside. European DJI, how are you, buddy?
I'm really good. Today is, of course, a really nice day. It's always great to have guests on the show, and we have Ian with us here today. Other than that, I've recovered from my flu that I had last week. I listened a little bit back to the podcast last week, and I sounded really different, but full of energy even after a full week of work. I had no time to check my portfolio, but as dividend growth investors, we don't need to. So it's always really literally sleep well at night, and yeah, just loaded with energy. How about you?
I can see that about you actually today. You look a lot better than last week, if I may say so, and there's a lot of energy flowing. But hey, I'm excited. Ian, welcome back to the show. I was saying it just before we came on. I can't believe it is almost 100 episodes ago since we had you on last, but I'm excited to have you on again.
That is unbelievable. It's been that long. I am so honored and excited to be back on the podcast today. Thank you so much for the opportunity today.
Yeah, I think the honor is all ours. The last time we've learned so much, and I'm pretty sure looking at the questions, us and our audience are probably going to learn some new nuggets again. So I'm looking forward to that. But before we get into asking you some questions and some of our listeners' questions, we're going to talk a little bit about the news of the weekend. And maybe is there anything you'd like to share?
There is so much news lately for dividend stock investors. One of the pieces of news that I thought was really exciting or interesting, relevant, at least to many investors in the US, is there's a company 3M, and it has sure been a difficult dividend stock to own because it has trended down quite heavily over the last few years. And one of the reasons it's trended down is just because it is a cyclical company. And so as our economy kind of ebbs and flows, we're in a little bit of a cyclical downturn now. And so we see earnings per share correcting, therefore the stock price going down. But also what has happened to 3M, unfortunately, is they are facing some litigation lawsuit issues. And the biggest one that is at the forefront of the news right now pertains to the earplugs that were used by combat veterans. And there was some news, though, yesterday that came out of 3M, and it's very early. I haven't heard other investors yet and their perspectives on the news, but I generally felt like the news was positive for the share price of 3M. I have to be careful how I discuss this topic because it's a sensitive topic, and my heart goes out to anyone who is a veteran or who has been involved in combat. And so I certainly want to put that out there first. But what the news was saying, and this came on the News Center on 3M's website, is that the Department of Defense data that came out of the U.S. Department of Defense is suggesting that there actually was no hearing loss among the vast majority of plaintiffs in the combat arms earplug litigation. So the Department of Defense data that 3M was alluding to is suggesting that 90% of the plaintiffs in this case against 3M, they in fact did not have any hearing loss. And obviously this is data coming from a reputable source. And so I noticed that 3M stock was up on that news, but still this stock has just plummeted. It is trading, in my opinion, at deep discount levels. The PE on the stock, I think it's about a 12 or somewhere in that range, but that's actually on 2023 forward EPS, which we know is a lot lower than where EPS was at during the cyclical peak. I think it was up around $12 or something back then when they were firing on all cylinders in the cyclical peak. But anyway, the starting yield is over 5% now. But obviously, there's a lot of risk with this litigation. But I just thought that this was a very relevant piece of news to the overall discussion on 3M. I'd say another big piece of news and that just caught my attention is I do own a stock in Altria as well. Ticker MO. In fact, before we go further, I guess I'd just like to say anything I mentioned today, it's not investment advice. I'm just sharing my personal journey here on the podcast today. And any tickers I mentioned, stocks, I do own those in terms of full disclosure. And so certainly please do go out and consult your own financial advisor before making any financial decisions. I'm just sharing my journey. But what's interesting is I do own shares of Altria, and that stock also, it's kind of like 3M. It hasn't been as bad as 3M, that it hasn't really gone anywhere for a number of years now. And I think one of the reasons is they spent, I believe, upwards of $10 billion acquiring Juul, which is a electronic alternative to traditional combustible products that Altria sells. But what was so interesting is Juul was a complete failure, and they did very poorly with that acquisition, and it set the company back, but possibly created a value buying opportunity for investors with a long time horizon. But what was interesting to read in the news this week is apparently Altria is in talks with the company Enjoy, which is basically very similar to Juul, and they're in talks to potentially acquire that company for $2.5 billion. And so I thought that was very interesting news, and it makes me wonder, is this just going to be a same thing that happened with Juul? Or if they go through with this, are they just going to throw out money again and create a lot of legal risk? Or could this actually be something positive for the company for their future? And I would like to also add with that, it's kind of like the 3M one. I guess it's a sensitive topic that I'm discussing a sin stock here. And of course, everyone has different opinions on that category. A lot of people don't like investing in those types of stocks. And so, of course, anyone listening should only do is what makes sense for their personal situation. But I'm just speaking to some news that really caught my eye just in the last few days.
Yeah, well, it's really interesting about 3M, actually. This is really good news for everyone. If those 90% of the people didn't have hearing loss here, come on, that's great news.
That's right.
And for us, it's always really awkward as Europeans to understand how this litigation process works in America, because we don't have such stuff here where there are lawyers collecting millions of people to be part of a filing. Well, it does happen, but not to the scale that we always hear from America. That's great news. So I really hope that this provides some light in the end of the tunnel. And if 3M, via the company they acquired at the time, did create issues to people's and impacted hearing loss, of course they need to pay for that. Yeah, and I hope that they can quickly get it behind them. And also because the Chapter 11 everything failed, we also saw that with Johnson & Johnson, so that's not their sneaky way out. So yeah, let's hope. And around Jules, what is interesting here with Altria is that the issue that they also have with selling those heating products in the US is because of the patent claim that British American Tobacco put there. So many of our listeners are long British American Tobacco, and also I think these kinds of things contribute to that. And I don't know what it means for Enjoy. I would assume that British American Tobacco is suing everyone that's infringing their patents. So if Enjoy can be sold in the US, then I assume that they're fine from that point of view.
Yeah. And in terms of full disclosure, I actually do own British American as well. And that's been a hugely successful dividend stock for me over the years, especially a fun story. They acquired a company in the US called Reynolds American. And that was one of my best performing dividend stocks of all time. And when that was acquired, I think they provided, I don't remember, it was a long time ago, but I think I got some shares of British American. I had already owned it. But I also got a cash payout, but I took the cash and reinvested it into even more British Americans. So I know some of your listeners were asking on Twitter. I noticed, Ian, do you invest in any European companies? And British American is one of the larger ones.
Yeah, so when the topic of sin stocks, so I owned it as well, like 1.5 years ago, 2 years ago, and then I shared my annual report with my wife, and she saw like, "Are you owning tobacco stocks in our portfolio?" Now I didn't know how quick I had to sell it. It was like literally out the next day, because otherwise it was like, forget about all your dividend growth investing. Then you have to stop. So
Yeah. Okay. Yeah.
Happy-
Fair enough.
Happy wife, happy life.
That's right.
exactly.
Yeah. Hey, listen, there was one piece of news that I saw this week, which was yesterday in relation to Blackstone, ticker symbol BX. These guys seem to be in the news a lot lately, and it's all pretty negative. This time they defaulted on, I think it's a 531 million backed bond to a Finnish property firm. I mean, it's probably not going to impact a company like Blackstone, but it's certainly not a good look. Reputation wise, it has to hurt them. But I mean, they seem to be in the news quite a bit lately, and it's all pretty negative. It's probably, I mean, they were buying up real estate, weren't they, at zero interest rates, and now we're starting to see interest rates go up and up and up. And I don't think this will be the last default bond we'll see from these guys.
Yeah, this will probably also have quite a ripple effect through the market there. We see already in the Swedish real estate markets with all these dividend cuts there, because also of leverage and the interest rates at the moment. So I think we're actually experiencing kind of such a slow, how is it, and delay wave going through the real estate sector at the moment.
Yeah,
absolutely. I noticed that news as well. And one of the colleagues that I work with, who's been through many cycles of real estate, had told me years ago that when real estate goes down, it's always like he calls it a slow motion train wreck, because things unfold slowly and it's painful to watch, and it can take many years to fully unfold. But I saw that Blackstone news, and I thought, hey, maybe this could even be the beginning of this slow motion train wreck in the office space industry, because we know right now no one's really occupying many of these offices, and the interest rates to service the debt are just keep going up. And so I really thought that was a very relevant piece of news as well.
Yeah, I mean, it doesn't seem to have affected Blackstone in terms of price action over the last couple of days, but I'm pretty sure with news keep coming out, we might see these guys fall off a little bit. I mean, it's inevitable, I think, at the moment.
Good, but it sounds like we need some better news here, because so far, guys, this year there have been so many tremendous dividend hikes. And if we talk about dividend growth investing, I mean, I don't know how it's for you, but for me, dividend hikes always put this smile on my face. And I believe we have seen really many double-digit hikes. Actually, we've also seen some dividend cuts here and there, with VF Corporation as an example here. So, but maybe a question to you, Ian, like, how do you look at this kind of season, the first 2 months when the annual earnings are being announced, all these dividend hikes, and are there any companies that stood out to you this year?
That's a really good question. This year, and maybe it's because of social media and the fact that all of us dividend investors are kind of getting together and sharing this great news, it almost seems like the dividend hikes this year have been stronger than I would have expected. There have been so many good hikes coming through. The one that really caught my attention recently was the Home Depot. That's actually one of the larger positions in my portfolio. It's actually my number 8 largest position that I own. And what was so exciting about the Home Depot is not only that they increased the dividend by 10%, but also that it continues a very strong cycle. Over the last 5 years on average, the Home Depot has been increasing their dividend by 15.2% per year. And so that actually, out of all of the companies I own, especially the larger positions in my portfolio, Home Depot has really been the strongest in terms of dividend growth. And we all know that at these types of growth rates, if it just continues for, say, 5 years, 10 years more, the opportunity for a tremendous yield on cost, it's really there. It's quite fascinating. And what has surprised me this year so much about the dividend increases is maybe I'm too pessimistic, but I really do believe we're headed into recession here, and I believe our economy is starting to cool off. We see the inverted yield curve right now. We see the very high interest rates. We see things like Blackstone defaulting on their commercial real estate loan. And I start thinking, boy, we're getting close to some rough times, potentially to a sideways market and economy for some time. But then when I see the dividend news, it seems like all of the companies I own, they're not looking at things the same way that I am. They're continuing with these very strong dividend increases. And the Home Depot, it's just the tip of the iceberg, so to speak. PepsiCo as well just came through with a fabulous dividend increase. This one was a little bit further back, a few months ago, I guess, but McDonald's is another one. And these are some of my largest positions as well. Pepsi and McDonald's are 3 and 4 in terms of size in my portfolio. So to see these just incredible dividend increases, it really is meaningful for my own portfolio. And I know for many dividend investors who own these types of companies.
Yeah, and the one that you just mentioned about Pepsi, that one actually caught my attention, because here with them, I would have liked to seen a lower dividend hike, because the payout ratio feels already so high. So I was wondering, like, they're with this really showing a lot of confidence in their own earnings power and their earnings growth power from that point of view. And maybe that is also then maybe a little bridge to a question that we got from 2 other people. Is like, how do you look at the dividend safety in this regards, right? If you feel like a
Right.
recession might be coming up, there might be those companies that are hiking now double digit might be actually sensitive to recessions, some of them. So how do
Yeah.
you judge that in the context also of dividend safety, and what means dividend safety for you?
That's such a good, complex question. I have so many thoughts around that. Before I even get into dividend safety, one of the things that was going through my mind when I saw PepsiCo's dividend increase is more just looking at their yield. And overall, right now, the dividend yield on Pepsi, it's getting close, I think, to about 3%. And here in the US, the dividends from companies like Pepsi are considered qualified, and that means they're taxed as long-term capital gains, and that is a much more favorable rate of taxation than interest income, which would come from a treasury bond by comparison. That would be taxed as interest income, which is ordinary income. Now, treasuries, though, they have some tax benefits, I guess, in the sense that my understanding is they're taxed at a federal level, but typically not state. Needless to say, one of my theories and my hypothesis, and I could be completely wrong, but I think one of the reasons that the dividend companies are going a little stronger than they probably should on the dividend increases is I think the CFOs at the companies are looking at the bond market, and they know that big investors are always making decisions between stocks and bonds. And I think they also know that the market is somewhat efficient, and that if bond yields go high enough, stock prices will go down so that the yields from the stocks will normalize with the bonds. Now, with bond rates right now, short-term money being around 5%, I don't think PepsiCo stock would drop enough for the yield to reach 5%. And the reason being is that's the shorter part of the yield curve, and also Pepsi is a qualified dividend, as I mentioned, and Pepsi has built-in dividend growth. It's an operating business. That being said, I think if Pepsi's dividend were down around 2.2%, that is just too low as compared to where bond yields are at. And so I guess what I'm saying is my hypothesis is that some of these CFOs and companies are increasing the dividend a little more than they otherwise would, even maybe a little bit in a manner that might not be financially prudent, because they're trying to keep the stock price up, because they know that a lot of stocks trade as compared to where bond yields are at. I hope that makes sense, but that's one of my hypotheses. And again, I could be wrong, but I think it's an attempt by these companies to make sure that their stocks don't go down too much as bond yields go up. Because again, investors have choices now, and they can get 5% here risk-free. Again, the 5% is taxed higher. But going back to the root question about dividend safety, I look at the metrics probably very similar to most other investors out there. The first test that I take is I look at just payout ratio as compared to the earnings that are coming in. How does the payout ratio look? And the payout ratio could be very different by industry. For the healthcare industry, stocks like Johnson & Johnson, I'm used to seeing that payout ratio in the 40 to 45% range, typically below 50%. And those types of companies, that's just where characteristically I have seen the payout ratios. I feel comfortable with the payout ratio. With a sin stock, by contrast, like a British American, I wouldn't be surprised if the payout ratio were a lot higher. Those companies don't involve as much innovation. Those types of companies also want to get cash off of their books and into the shareholder's pocket, because otherwise it could be a litigation target if they have too much cash sitting around. And so I would be very comfortable with a payout ratio at British American or Altria up around 80%. And in fact, I think Altria stated that their target is around 80%. That's why I was surprised their last dividend increase was a little slower, and their payout ratio now, I think it's in around 75, 74%. And so there's actually a little room there for them to grow it. Now, there are other companies I own. I'll give you a great example where I'm a little concerned. I own Leggett and Platt. This is a smaller company. It's only around a $4.5 billion market cap, I believe, but their payout ratio is now above 100%. And this happened to Clorox actually post-pandemic as well. It'll be interesting to see. That one is in a very risky territory right now. They're kind of like 3M in that it's a cyclical industrial company. And unfortunately, we're in a cyclical downturn, and I think it's just starting. I think this could last a few years. And the question is, will Leggett and Platt be able to keep up their dividend king status by continuing to pay and maybe even increase slightly their dividend over the next few years? I don't know, but financially speaking, right now, that one is in a rough territory. Thankfully, Clorox actually pulled through their tough times, and it seems like they're headed into better times now, because there was a backlog, or I guess there was a front-loaded purchase on most of their products during the pandemic. So then after the pandemic, no one needed to buy those types of cleaning products anymore. But now it seems like the demand is coming back, and they're probably doing okay. But anyway, payout ratio is the first metric that I look at. But then I like to dig a lot deeper onto the statement of cash flows, because on the statement of cash flows, the most important metric that I think a lot of investors miss are capital expenditures. And capital expenditures don't really show up on the simple payout ratio test. But basically what capital expenditures are investments that companies need to make in their property, plant, equipment to keep their business going, to improve their business, to modernize their business. And oftentimes, capital expenditures are framed as a one-time expense. But what I've typically found with most of my companies, when I look at them over long periods of time, is the capital expenditures, they're actually pretty consistent. And it's a real line item. And so what I like to look at is the statement of cash flows, and to understand, well, after capital expenditures, are they bringing in enough cash flow to pay the dividend? And sometimes the answer will surprise you. I don't analyze this number quite as closely as some of the other analysts out there, just for press of time. I don't look at it monthly or probably as quarterly as closely as I should. But I think that's a really good test. And I know that some investors have raised a red flag, so to speak, that they're unhappy right now what they're seeing with PepsiCo, for example, on their statement of cash flows and with the free cash flow and with their ability to pay for these ever increasing dividends given where the business is at. And that brings me all the way back to my first point that I don't think the executives at PepsiCo are necessarily, I think they know what they're doing. And I believe maybe they're getting just a little bit ahead of themselves on purpose to keep the stock price up, given where bond yields are at. That's the best I can make of it right now.
Yeah, and I think the capex is really nice that you bring it up, because I think Intel is really a nice example in case, because there are also people that look at return on invested capital a lot, just in general, to understand the quality of a business, maybe not so much about the dividend safety. But you can fake this number so much by just reducing your investments at that moment in time and boosting your sales. So sometimes on the short term, it looks like, well, they're growing hard, but actually they are just reducing their capex and they're not reinvesting in the business enough. And then later, now Intel pays the price for the lack of upfront investment when they had to do it several years ago. So yeah, good point.
So shifting a little bit from dividend safety, I noticed, and I think some of our listeners will as well, that you've shifted towards a high yield income investing strategy, and a lot of times people would associate high yielding with dividend risk, and maybe the dividend is more at risk. But maybe you can talk a little bit about why you've decided to follow this strategy. We notice you have teams every so often, and this year seems to be high yield income investing.
This is a really good question. And so I want to start just with my portfolio. Overall, my portfolio is very, very skewed towards dividend growth stocks. And I think the best way of illustrating that to everyone is when I take my current portfolio value, I look at that, and I also look at my dividend income. If I take my overall dividend income and I divide that into my portfolio value, right now, my average yield portfolio wide is about 3.2%. And so my portfolio, that tells a story right there, is very geared towards dividend growth. And in fact, when you look at my top 10 stocks that I own by value, they actually comprise about 52.6% of my overall portfolio. And when I actually go to my top 20, it comprises 76% of my overall portfolio. And many of you listening in know my top 10, top 20 stocks, because these are the household names that we talk about in the dividend community almost every day. And so a lot of the companies we've already discussed, but companies like Johnson & Johnson, Starbucks, Pepsi, so on and so forth. And so when we started out in this year, my goal actually was really to focus on my core 4 holdings, which are Starbucks. Well, Starbucks I don't need to, because now it's number 1 by a huge margin. And so I have almost an over allocation to it. But Johnson & Johnson, which I believe is a value right now, I'm excited to be buying it, Pepsi and McDonald's. Now, throughout the first quarter of this year so far, I have been really focused on adding to Pepsi and McDonald's. I've been successful with those goals. And also, I've been there's been a few things going on. Macroeconomically, I'm seeing interest rates increase. And as interest rates increase, it puts in my mind this question: if I can get 5% risk-free, should I even be buying Johnson & Johnson right now at a 3% yield? That's a really good question. Obviously, there are tax considerations as well. But when I look at Johnson & Johnson, let's just take taxes out of the equation. For Johnson & Johnson, simple yield on cost, not looking at their dividend reinvestment, assuming I just spend the dividends. But if I look at simple yield on cost and I assume that their dividend is going to increase each year on average by 6.1%, which is what it has been increasing the last 5 years, it would take me about 9 years actually just to reach parity with the risk-free rate right now, which is 5%. And I also believe in general that interest rates are going to stay high. They may even go a little higher. There was some news out of the Fed this week that basically there are no signs of interest rates going down anytime soon. And so I start thinking about my portfolio overall. And many people who follow me, they know I rarely sell stocks. And so the companies that I own, the portfolio that I have, I will let it sit. But as I look towards the rest of this year, I am moving more towards high yield. And part of that is just driven by the interest rate environment that we're at now. I basically feel that, hey, if I can get 5% risk-free, I want to replicate that kind of starting yield with the dividend stocks that I'm buying on average. Also, I was actually inspired by a book that I read called The Income Factory by Stephen Bavaria, where he talks about high yield strategies. And that book was suggested to me by my friend, the Dividend Monster, over on Instagram. His name is Greg, and he retired off of dividend stocks recently. And he's been repositioning his portfolio a bit towards higher yield stocks. And so those factors got me thinking about high yield as well. Basically, what I've concluded in my own dividend stock portfolio is I'm going to do high yield my own way. And so I know there are a lot of investors who go towards covered call ETFs, mortgage REITs, different types of high yield investments. And another one is closed end funds. And I'm keeping an eye on all of those types of opportunities and learning more about them. I have a lot to learn. I don't want to necessarily jump into those investments in a big way before I really understand them. But what I'm doing for high yield, I actually just published a video this morning, is I'm looking within my own portfolio of dividend stocks, qualified dividends, because I am in a higher tax bracket. I do have to pay attention to the tax situation. So I always prefer qualified dividends in my portfolio. But I've been going through my portfolio and I've basically identified 15 different stocks in my portfolio that I want to focus on for the next year or so for new capital. When I add new capital to the portfolio, I want to deploy it into these 15 stocks. And what I found is I've created basically a list of 15 stocks, and the average dividend yield for those 15 stocks is 4.54%. Now, that's close enough for me to my 5% risk-free rate, and it actually is probably better than the 5% risk-free rate because the tax situation is better. But I also know on average that these companies, these 15 stocks, are increasing the dividend by 5.3% on average per year. And so I've got dividend growth comprised into the equation as well, which is nice. And so this basket of 15 stocks, I've got some core quality stocks in there like Johnson & Johnson, Pepsi, McDonald's, but I've also got the higher yielders in there. And one example would be British American. Another one is Altria, even Bank of Montreal. Now, Bank of Montreal, some people wouldn't really call it a higher yielder, but for me, it's yielding 4.46%. That's a pretty solid starting dividend yield for me in the context of my overall portfolio. And they're growing the dividend on average by about 7.3% per year. And so basically, I wanted to clarify that because when I say high yield, it may mean something a lot different than what other investors mean by high yield. A lot of investors who say high yield, they're speaking about 10% or more. But for me, high yield is just skewing my own portfolio of really quality core dividend stocks towards a higher starting yield that's more on parity with the risk-free rate. That being said, I'm not against or opposed to those 10% yielding companies or assets, but what I've identified is I need to learn a lot more about them before I could venture out into that world.
Yeah, and it's really interesting that you say that about the high yielders, because for me, it's the same. High yielder, for me, it's really something around 6%, 5%, 6%, because it's almost twice what you get elsewhere when you talk about some of the high quality stocks. And 10% for me, that's usually already red flag, because then you're talking also about companies that need to have an earnings yield of about 10%. And that's really rare in the current environment here, and that reduces the dividend safety at the same time. And what I also like what you says about the 15 stocks, we often say here, like for instance, if you want to buy low yielders, buy a high yielder besides it, and you kind of nicely average it, and you get also the average dividend growth together, right? And so it's never really either or. You can do both at the same time and still get a much better yield than you would get elsewhere.
That's a really fabulous point on buying a high yielder and a low yielder. And that's honestly what I was doing with these 15 stocks, because if I was just buying Johnson & Johnson, I don't think it would make sense in this current interest rate environment, because again, it would take 9 years just to get to 5%. But if I pair Johnson & Johnson with Altria, it makes total sense as a basket of companies that play different roles on the team. And I also agree on your point about risk. For me, my high yield strategy is a reflection of my risk tolerance, and my risk tolerance these days is low. And I don't want to take on undue risk with possible dividend cuts or even the underlying asset value going down. I like to sleep well at night, and I'm willing to take a lower yield in my portfolio to accomplish that goal. And so I think that's important for listeners to understand as well, that for me, my risk tolerance, it may be very different than others out there.
Yeah. And how does that then relate maybe also to this element of crypto? Because we also know you had a bit of a YouTube channel, Crypto. I'm not sure if you're still doing that. How does this fit into the mix with your, let's say, 2023 strategy or theme, high yield theme?
So I have a lot of thoughts on this topic. This is a interesting topic. Over the years, I have done a lot of experimentation in my portfolio, a broader portfolio, not just dividend portfolio, but financial strategy. I have really done it all. I have invested in angel companies, for example, and most of those have been complete failures, unfortunately. And so I have way back in my early days, this was maybe 25 years ago or so, but I tested out penny stocks. That did not end up well. And so I've tested pretty much everything, and I try to always have a allocation in my portfolio for testing. And cryptocurrency, boy, what an interesting topic. So I still do own crypto assets. I do not discuss it much anymore, because what I found first and foremost is I cannot even keep up with the pace of the industry. I think that I took a step back and I analyzed just my life. I have a full-time job. I do my YouTube in addition to that as a fun hobby that I just am so passionate about and I love. And I am a husband and a father of 2 amazing kids. And so there's just an awful lot of things going on in my life. And I realized with crypto, it is evolving too quickly for me to keep up with that. And so that channel, I actually did decide, hey, I can't keep up with this anymore. If I want to do YouTube, I just want to focus on the one channel on dividend stock investing. But for those who are interested, cryptocurrency, it's a very small portion of my overall portfolio, and I have held on to my crypto assets. So I still own those assets. I'm keeping them for the long term. The largest one that I own is Bitcoin. I still believe that there could be some long-term promise with that technology. I am thankfully have received a positive return on Bitcoin because I got into it really low. I started buying around in the $3,000 range, and now I believe it's trading up around 20,000. And so Bitcoin, I would say the downside of that particular cryptocurrency is there are a lot of people that don't like it right now, including Warren Buffett, Charlie Munger, different governments around the world. And so it has a lot going against it as well, unfortunately, which could keep it from fulfilling its opportunity. Now, I do have other crypto assets in my portfolio where I have lost money. as many crypto investors have. And so those, I haven't sold them, but those particular assets, I have been a test that did not pan out. And so I'm in a wait and see mode here. I'm holding those assets. I'm not really adding to them. I'm going to see what happens over the long term. I would say the last thing I just want to say about crypto is, unfortunately, it seems to me that that entire industry had an awful lot of opportunity and promise, but there were some terrible bad actors that came into that industry and took advantage of investors by running their operations incorrectly. And so that was something as well that I think cast a lot of doubt on the industry. And unfortunately, it could have set the industry back to a point where can it even recover from that? I don't know. And so that's where I'm at with it. But I'm basically at a high level in a wait and see stance at this point. And I like the underlying technology and the promise. I don't like what has evolved in the industry over the last year or so. And I don't know if the industry can recover from it. A wiser investor than me might choose probably just to sell it all. But for me, I have a real trouble. It's very rare that I sell an asset. So again, I'm kind of holding to see what happens.
Yeah. It's the regulation part, isn't it? It's on one sense, a lot of people like that it's not a regulated environment, but on the other hand, it creates a lot of, as you said, actors and lots of people coming in and hurting investors. So I had crypto for quite some time, but I'm completely out of it as of this year as well. It's a tough space, and as you said, it moves super fast. You have to stay on the pulse nearly 24/7. It changes from day to day. So
what I also like here is, Ian, that you have this kind of allocation to your portfolio to test things. I have the same. I've got 10% of my portfolio that I use to nurture my value investing kind of mindset, which is not necessarily the same as dividend growth investing. So I've got Alibaba in there, I've got Intel in there, and sometimes I have a feeling I'm just paying a 10% price to remind myself all the time to stick to dividend growth investing, which is quite an expensive commission if you think compare that to what I pay to the brokers for buying shares. So I'm not good enough in it yet. But it's hard to stop this curiosity, which you seemingly also have, right? Because we spoke also offline one time about Dutch Bros and such. There's just so much opportunity out there, right? And for me personally, I need to nurture this. If I don't do it, I also go mad from one point of view. But yeah, sometimes it just costs me money.
That's a really good point. And honestly, one of the things that intrigued me about crypto, and honestly continues to, is the technology itself. And sometimes I'm like you, I experiment with these new technologies just because I want to learn it. And at the time when I was very into crypto, I believed that this could be a big part of the future of our society. And if it were, I better learn about it so that I have these relevant skills for my job. But I've also concluded very similarly that when I've tested so many different things over the years, I always come back to dividend stock investing. It's really the single investing strategy that for me has just worked really consistently well over the years. And I'm so thankful for that. And as I do get a little bit older these days, I don't know if I'm going to keep testing as much as I have in the past, but there's always going to be that part of me probably that wants to test different types of investing.
And you mentioned age here. And at a certain moment, we even start to see retirement age somehow, whether we like it or not. And I'm just wondering, how far off are you from financial independence? Because you've been quite long on the journey. Are we talking here about 1-2 years, or are we talking still about, let's say, a decade or something like that? How does that look for you, this picture?
This is a really complex question. I think the answer for someone else in my same situation, they would answer the question very differently than me. I've chosen a life that I would say being financially free off of dividends, also given my level of risk tolerance and given our overall living expenses. I've kind of made it clear, I think, to investors over the years who follow me that I'm more on a fat fire, if you will, strategy where we do have high living expenses. We do go on vacation, and we have multiple vehicles and nicer things, and I like to buy new clothes and sneakers and all kinds of things. And so I would say the life I live is probably not the best situated for early retirement. But that said, I'm trying to do the impossible. Basically, where I'm at right now, also, I think another way to answer that question is I really love what I'm doing. I left many years ago now the traditional corporate career path to work in the real estate industry. And in the real estate industry, what I do is a lot more entrepreneurial, and I own my own consulting company, and I can in many ways set my own hours, and I have a little more flexibility in my life than I did before. And so maybe I wouldn't have had the full confidence to do everything I've done without the dividends being there to support what I do. Basically, where I'm at right now is I would say I'm semi-fire or semi-financially free. Some of that has been also improved over the last year because of geo arbitrage. We decided to sell our home in California and move to Idaho. And there's a different cost structure of living in Idaho versus California, but there were many other reasons that we moved as well that made sense for our family, especially for our kids. My wife and I thought that this would be an amazing place for us to raise our family, and we were right. It has exceeded our expectations so far. But what I'm saying is, through that geo arbitrage, there's been a related benefit of getting closer to fire and improving upon the semi-fire that we already have. And so when I get this question, Ian, when are you going to retire? It's a really tough question. It's not really my goal anymore, so to speak. My goal at this point is more of increasing upon the semi-fire that I have. The more money that I can receive in dividend cash flow, the less pressure I have to work as many hours as I do right now. And so the strategy I have at this point, as well, is I really love what I'm doing at work. I don't really want to slow down too much or completely retire. I have family time. We enjoy our weekends and nights and days together, and I see my kids a lot, which is amazing. And I don't know. It's just such a hard question to answer, and it's such a imprecise answer that I'm giving. So I don't know if this is really the answer that the subscribers were hoping for or were looking for. But when I started all of this, yeah, my goal was I just want to live off of dividends. And of course I still do. Everyone does. It's such a amazing accomplishment. But realistically speaking, with our cost structure and just where I'm at in life and everything, I'm looking at this point just to amp up my semi-fire. I think another nuance that's really important to mention to everyone is I've done things, quite frankly, in our broader financial planning that make it harder for me to get to fire. This one is going to be really controversial out there. I've spoken about it before on my Patreon, but that's really it, because I know it's such a controversial topic. But for me, at least, I own whole life insurance, and that is an added bill that I need to pay monthly until I'm 65. And that goes, against fire. It creates more recurring expenses. And that made sense for my financial situation because of what I'm trying to also accomplish multi-generationally. I'm trying to set up the future generation for success as well. And so the picture at this point has gotten broader than myself. And I'm thinking about the future, and I've kind of struck a nice balance in my life that just makes sense. But at the same time, why am I going after high yielders right now? One of the reasons is I want more income right now, because I also do want to continually amp down the amount of hours that I have to work. And I think that's the big takeaway from all of this is so many dividend investors, they feel like it's all or nothing, but it really isn't. There are so many opportunities, even when you reach semi-fire and can start working fewer hours or work a part-time job or work different jobs that pay less but are more enjoyable to you. And so all of those options are always on the table.
I think lots of actually of our subscribers would actually fully buy into what you're saying, because we have this discussion quite often, and we hear so much that people just like what they are doing. Many people are in a fortunate position that they have a job that they like. But for instance, being able to work 32 hours or something as a part-time job, spend more time on your hobbies, therefore, just increases the quality of life. As an example, if I would hit the cost expense crossover point, I don't see myself straight away the day after handing in my resignment at work. I like my work too much. I can imagine that I say, like, you know what, I'll take some more breaks for charity. If that takes a cut off my salary, so be it. Yeah. I can imagine even that I do say after a while, okay, you know what, enough in corporate. I'm going to do something more charitable. It will be still work. Yeah. And maybe I do some Uber driving then 1 or 2 days to compensate the difference or something like that. But this is, I think, what the difference between financial independence and financial freedom is, because financial freedom gives us really options to really significantly enhance the quality of life, have discussion for hardship when there isn't anything. And I think this is what dividends really empower us to do. And that's, I think, what's driving many of us here.
Absolutely.
Cool. I think it's a good time to move on to some of our listeners' questions. We have quite a few to get through. And we might start with Phil. Phil's a regular listener of ours, and we usually start with his questions. So his question today is, he's currently thinking about reducing the number of positions in his portfolio to consolidate it. How would you approach that if you had to cut your positions in half?
This is an interesting question. I always think about this myself, because sometimes I own 50 stocks. I felt like sometimes it's too much. For me, I have a very difficult time selling stocks, although I sold one recently. So what I typically do just speaking to my own situation in my own portfolio, is rather than reducing positions or selling positions, I just try to allocate money towards the positions that I want to comprise the largest percent of my portfolio. Because whereas I own a tremendous number of stocks, 50 different stocks, when I actually look at my portfolio, I'm just pulling it up on my screen right now, those top 20 stocks, again, they comprise, top 15 even is 66% of the portfolio. And when I go all the way to top 20, it's 76. And so what I've personally chosen to do to streamline my portfolio and get it centered around those positions that matter the most is I make sure that I just deploy the money in those positions and not the ancillary long tail of positions. And one thing I've also done to increase that effect is I turn off dividend reinvestment for the positions that I'm trying to shrink in size. And I take those dividends and I selectively redeploy them towards the larger positions that are more meaningful in my portfolio. But for me, it's very rare that I sell a stock. I just have a hard time doing it. Typically, I will only sell a stock if I realize I really made a mistake. I just bought the wrong thing. It's not, it happens. I think that's one of the challenges is sometimes people will comment on one of my videos or they're like, Ian, you were really wrong with this one. And I'm like, Yeah, I'm just like you. I might have a YouTube channel with a lot of subscribers, but when it comes to investing, I'm on the same journey as everyone else. And sometimes I buy something that turns out it just wasn't the right investment. And in those rare cases, I am willing to sell. One good example of that is Orion Office Properties. This one was a spin-off from Realty Income, which is a real estate investment trust that a lot of US-based investors, they really like it because they pay the dividends monthly. It's the monthly dividend company. But they spun off this suburban office REIT. And I actually not only held it, but I bought some more shares. Eventually, though, I ended up realizing, you know what? I crunched all the numbers, I ran all the analysis, and I guess I just must have miscalculated. It didn't, that investment did not pan out the way that I had thought it would. And so I ended up selling. And so I think that's important to mention to people listening, because sometimes, you watch either myself or you're listening into the podcast today, or you're watching, a random YouTube channel. And I think most of the people out there, they're continuously trying to improve, and that's the whole point of this community. But all of us are on the same journey, and no investor is perfect. Even Warren Buffett has made some mistakes here and there. They're very rare, but he has. I know right before the pandemic, I think he was buying those airline stocks. I don't think that worked out very well for him. What's so funny, though, on a side note, is Warren Buffett sometimes, I've even thought that he's made mistakes, and it turns out that over long periods of time, he was actually right. And so a lot of the time we think, oh, he made a mistake, he shouldn't have bought Occidental Petroleum. But you know what? It actually seems like that's turning out to be a good investment. And so that's one of the fun things too, is just how time is such an important factor with all of this. But anyway, I guess a long answer to that question about how to right size a portfolio or focus it. But that's where I'm at, is as long as a company I bought is of quality and my thesis has not changed, it's performing well, I just cannot bring myself to sell it. So that the way I redo it is just through deployment of capital and selective deployment of dividends.
Yeah. And how is it? We have actually also as a next question, a question. This is from the Kleine Kapitalist. I don't know if you follow him on Twitter, but he is the master of what we call chart porn. And maybe you can see it in a document also where he shared a nice picture of Union Pacific. And generally and such, he in this case, he's asking what your wife thinks about when you're watching these kinds of charts. But generally, do you get inspired by these kinds of charts and such? What are these things that, let's say, beyond the numbers really inspire you when you're kind of, as part of dividend investing?
I love the charts. They're so much fun. And I'll tell you, I am really blessed because my wife and my kids are so supportive of my obsession with dividend stock investing. In fact, the other night, I was up late with my wife. We were looking at the laptop and we were looking at different investments, and we were looking at just the interest rates and CDs and different investment opportunities. And so, boy, I just have to say that thank goodness I am so lucky with my wife and kids that they're supportive of my hobby and passion for investing, because I do spend an enormous amount of time on it. And I'm so thankful too. We're always trying to challenge each other and constantly improve. One topic that my wife and I are actively discussing right now is just how our family can save more money, and what are some expenses we can cut back so that we can save more money for our future, for our investing, for our retirement. And so I just love that that dynamic about our marriage and our family. But what I would say, what inspires me, surely I love the content on Twitter, Instagram, YouTube, and sometimes I wish I had more time, because I spend so much time, and I'm sure you guys know this as well, when you actually are creating content, it's a lot of work, and then there's not as much time left to consume other people's amazing content that is out there. I would say for me, though, in addition just to the charts, what motivates me are seeing these dividend stocks increase their dividends, seeing them being shareholder focused, having an opportunity thanks to technology to connect with them on Instagram or Twitter, like just to say, hey, thank you, McDonald's, for that dividend increase. Who knows at the company who actually sees that tweet? But I know someone is. And with some of the smaller companies I own, like Dutch Bros, for example, I've posted myself with my Dutch Bros before on Instagram, and they will actually like it. And I see, oh, wow, someone at Dutch Bros actually liked my post. That is one of my favorite things. One of my favorite investing authors and just investors of all time. I'd say probably my number one favorite investor of all time is Peter Lynch. And he had such a passion as well for household brand names, just these obvious investments that are no-brainers, like that we see every day, like Pepsi or Starbucks. He had a passion for them. And I do the same. Just when I go to Starbucks and I know that it's my biggest position and I own it, there's something about that that is just so motivating to me that I can actually see and I can consume, I can touch, I can interact with the very investments that I have. And that is very, very motivating to me. I would say also what motivates me about dividend stocks in particular is it's a form of investing that is open to everyone. There is no amount that is too small. No one is excluded. Everyone is invited to participate. And we all do it our own way. We've got people like Greg, who I recently interviewed, who is going towards those high yielders. He knows a lot more about them than I do. And there are people like myself who play it a little more conservatively and have the swan-like sleep well at night dividend stocks like Johnson & Johnson or McDonald's or Home Depot. And then there's other investors who are really big into tech stocks or low yielding dividend stocks, but they're growing the dividend really quickly. And so everyone does it a different way. But what motivates me is seeing people build portfolios and win and improve upon their life and create more financial security, because it goes back to this point of, should we retire? Should we not retire? What I love about dividends is whether you want to retire or not, they just create a little more security, a little better sleep at night, a little bit better, less financial anxiety. If something were to happen at work, you know that your dividends always have your back covered. And so for me, just when I'm on Twitter and I see smaller investors, everyday people getting started or reporting their results. Hey, I got my first $100 of dividends, and seeing their excitement and seeing them build and improve upon what they're doing. That is so motivating to me, because I believe that this really is the opportunity for the everyday person. We all know how difficult it is to start a company. We all know how difficult it is even to get an advanced degree, to become a medical doctor or a lawyer or a scientist. These types of, it's a long path. I mean, some people take decades of education to get to where they need to be for their career. And we know some people can do that. Not everyone can. But what I love about dividends is whether you are a doctor, whether you are a business owner, whether you're a CEO, or whether you're just an everyday person working at Starbucks or McDonald's, or a janitor or a taxi cab driver or Uber driver, anyone can invest in dividends. And sometimes what I've found in the community, it's actually not the people with the advanced degrees who do the best. Sometimes people, I know this, I had my degree from Stanford in computer science. I tend to overthink things a lot of the time. And, sometimes what I just love about dividends is people of very different backgrounds bring so much knowledge to the table. And I would say sometimes the everyday person who has more control over their finances than I do, I've been the first to admit all these years that our expenses are on the higher end. We're getting better about them, but they are. But someone who has much better control over their everyday expenses, they might be at an advantage to me. And even though my portfolio is bigger, it doesn't matter how big your portfolio is. It matters how your cash flow compares to your living expenses. And so it's not all about the raw dollar amount. And these are the kind of things that just fascinate me and get me so excited about dividends, because it really is a tool that anyone can use to succeed, financially speaking, and also I think in their life, because you have those solid finances and it sets you up for just great success and happiness in life.
Yeah, what is interesting here is I think how I would call this, like, often streetwise is way more important, being
Yeah.
streetwise. And I recognize that myself as well, being very analytical. It is easily to get hooked up into the details. You always find 10 reasons not to invest. So I always need to remind myself of that. And what you mentioned about the social media accounts of the of the, let's say, the stocks we invest in, I do believe, I know you're really humble, that you may expect a little bit more answers from them, because in the end, they're your employees. Yeah. So if I send an email to my employees, I expect an answer. Yeah. So sometimes they could be a bit more responsive on social media, but I guess it's quite an unconventional way of looking at things.
That's a great point.
Good. I think we still have time for maybe 2 questions here as well for the podcast. I believe we have already addressed along the way many of our listeners' questions. And there's one particular that I really wanted to ask you, specifically also because of your background and your industry knowledge. And it is from Life with Dividends. He was not too long ago also on our podcast. And he asked, like, since you're involved in self-storage industry, what are your thoughts currently about the long-term growth trends in this sector?
That's a really good question. And so yes, I work in the self-storage industry, and in particular, I spend most of my time developing and operating self-storage facilities. And what we've seen in the self-storage industry, especially over the last few years, is it's an industry that's gone from kind of the ugly duckling of real estate to the darling of real estate. What had happened in the early days, way back, like in the 1980s and 70s, is a lot of people developed these self-storage facilities as a temporary use. They thought, hey, we're going to have this as a temporary use of this land, because later, when we have more money, or once the area has kind of gotten more built out, we're going to tear it down and build something better. There was this hypothesis back in those days that self-storage, it's not the highest and best use of this land. It's just a temporary land bank, if you will. But what has happened and everyone in those days used to look down on self-storage. It was kind of the ugly duckling of real estate. Everyone wanted to be in the office industry or retail or shopping centers or apartment buildings. And over the last 5 years, though, I would say that a lot of investors started realizing that, especially the newer, nicer, modern facilities that are built really well, that have advanced technologies in them, like individual unit alarms and 24/7 video surveillance and personalized access control, gate control, and so on and so forth, climate control. Those types of modern, beautiful self-storage facilities, I think real estate investors have finally realized that, no, this is not a temporary use. This is a long-term viable business model, and that this is the highest and best use of this particular piece of land. What also has happened, I would say, over the last decade, is a lot of investors have realized that, yes, it's difficult to manage any kind of property. It's a lot of work, but it's easier on a day-to-day basis, probably, to manage a self-storage versus an apartment building. Apartments are more work. But don't get me wrong, managing storage is hard too. It's just not quite as difficult. And so it's drawn a lot of interest. I think also you overlay the fact that all of us have a lot of things. We've been buying a lot of things on Amazon, on Walmart, which is another stock I own. We have a lot of possessions, and we need a place to store all of those possessions. I think generationally as well, the baby boomer generation is getting older, and some of that generation and the generation before them, they're passing away, and they're giving their belongings when they pass to their kids, and the kids don't know what to do with all that stuff. And so rather than have the time to sort through it all, a lot of them are choosing, hey, I'm going to store it. I'm going to put it in storage, and then later we could take the time to look through it. And so there's that demographic and kind of generational shift that has created a demand for more storage. And so I think a lot of consumers also are maturing, especially in the United States, and they're realizing that storage is part of their lifestyle. It's a part of just day to day. It's something that could improve its convenience, that can improve their life. Yes, it costs money. It's not always cheap, but that money, it's worth it to them to declutter their home and just to have an extra space out there where they could place their belongings. And so, long story short, there have been a lot of good, positive developments in the industry. But the downside of all of that is it has showed up on the front page of the Wall Street Journal as being a great opportunity. And when that kind of press gets out there, a lot of people have entered the industry, and there's been a lot of development. There's been a lot of new storage development, and ultimately self-storage, it is a commodity because, you know, whether you rent at my storage or the storage down the street, assuming they've both been built within the last 5 or so years or 10 years, they're both nice places. You're going to shop on price. And so consumers who shop at a storage, it's a price sensitive business. And when there are too many storage facilities built in a particular market, what will happen is there will be an oversupply per capita, and the prices to rent those units will go down. And obviously then it messes up the financial modeling, and the returns are a lot lower. Ultimately, I would say those that have started in the industry a lot longer ago are at a much better competitive advantage because their cost of land, their construction costs were a lot lower back then, and they've paid down more of their debt, so they have less debt to service. And so they're in a better position. I guess what I'm saying is I take a little bit of a not pessimistic view, but just a rational kind of contrarian view. I think I'll give another example. In where we live here, and we've people in the community, and that's what I do for a living. I work in the self-storage industry, and I cannot even tell you how many times people have said, "Oh, you work in self-storage. I've been thinking about building a self-storage. I heard it's a great investment." And I've heard this from so many people who don't even work in the industry. They've just heard through the Wall Street Journal or Main Street Media or their friend or their neighbor, this is a good thing. And so what I'm starting to see is a situation with high interest rates where people are high construction costs, potential oversupply, rental rates potentially going down as we head into an economic recession. And I am just trying to illustrate that it is a great industry. There is still a lot of opportunity. I think the industry is here to stay. The industry will do well over very long periods of time, but also, as with any investment, it's a good time to be a little bit cautious because we are in an environment now where something has been hyped up probably a little bit too much. And there's been a lot of new supply, a lot of new people still building new supply. And also what I would say is there's been some irrationally easy money in the sense that a lot of developers in the industry, they take what's called a syndication model. And what they've done with their real estate syndications is they raise capital and then they go out and they buy an existing facility, or they even build a new facility with that money. Now, a lot of the syndication money historically has been looking to take on lower rates of return. Some of the rates that these investors are making in these syndication deals, they're really low. And at a certain point, I think those investors are going to wisen up and they're going to want higher rates of return, especially given where the risk-free rate is at right now at 5%. And what I'm trying to say is a lot of these dynamics kind of set the scene that, yes, it's a great industry. Yes, there are some publicly traded entities in the industry that have done well, will probably continue to do well. They're awesome companies, but I think a lot of the best days and a lot of the hyper growth phase at this point is behind us. And I think for the next 5 years in particular, while we kind of figure out the economy and the recession and the interest rates, there's going to be probably a cyclical downturn a little bit, or at least some sideways kind of trending before the next big kind of upswing. And so I would say for anyone looking to invest or enter the industry or build in the industry, buy a facility right now, I would just tread with caution, as an investor would with any investment out there. I'll tell you, a lot of the storage industry reminds me of my Johnson & Johnson example. It's a great stock. It yields 3%, but it's going to take me 9 years just to get to the risk-free rate at the rate they're growing the dividend right now. And so it's kind of one of those types of situations right now, I would say.
And it's really interesting to learn from you here, Ian, because I always thought that only CIA undercover agents rent the self-storage to hide their guns and their legends. So I didn't, because here around us, I guess people just have more like a different, at least here in Poland, people I think have a different approach. Maybe in the big cities, they have more self-storage, but where I live, I don't even think it exists from that point of view. People just stuff up their basements. I don't know if you have basements where you live, actually. Is this a thing in America?
Okay. I'm so glad you brought this up, because I am speaking completely from a U.S. perspective, American perspective. And I think that's important because the publicly traded self-storage companies that a lot of dividend investors gravitate towards have the majority of their facilities in the U.S. When it comes to Europe, or really anywhere outside of the U.S., I have heard, I do not know that market at all, but I have heard exactly what you're saying, that there are not a lot of storages. There could be a good opportunity for someone who is really entrepreneurial and understands the local market to build facilities. The challenge, though, that I've heard is exactly what you're saying. It's one around education and kind of just the lifestyle. In Europe, what I've heard from a real estate broker that I've spoken with is that there's a lot of education, because a lot of consumers, they don't know what it is, and it's hard for them even to understand why they would want something like that. But here in the US, education is not the problem. Everyone kind of wants it because we all need more space, because I think we're very much a consumer-oriented nation. But the challenge is more of oversupply and interest rates and economic recession. Can the consumer continue to afford to pay for it? Those kind of things. But I think in Europe, yes, it's a very different landscape where it's more of an educational thing at this point, educating the consumer why they would want something like this.
Thank you. I'm sure that Life of Dividends is really, he has he's well fed with the knowledge here. So I hope he can make this to use. And then maybe the last question for today is actually your ownership of European stocks. So before you answer, I know now you have British American Tobacco. Yeah. And I remember you have Unilever. Yep. And you have Danone, I believe. So 2 consumer staples. Is there anything else you also own still from the European continent?
I do, actually. I own Shell, so that's one of my positions in the energy sector, and I also own BP, so another energy stock as well. So those I believe, to the best of my knowledge, it's hard to remember all of my 50 stocks, but those are my pure play European companies. Now, what I would say as well, though, is there are other companies based in the U.S. like Philip Morris International, which is does not really do business in the United States. It's only outside of the U.S., but their headquarters and their company is operated out of the U.S. So I think that one is worth mentioning. And also, I do own a few Canadian companies, but we're still talking North America there. I would also say, worth mentioning, is I do own some companies like McDonald's, whereas you wouldn't think of it necessarily as a European company, but I know that 60% of their business, I believe, is outside of the US. And I imagine a lot of it in Europe. So there's that. I think about things that way as well, that I get that global diversification. And at one point, I was actually measuring that portfolio wide. I was measuring I went through every company I own. I went through their annual report, and I tried to partition out how much of their sales is happening in the US versus outside of the US. And so at one point, that was a metric. I don't have it in front of me, but that was one I was actively looking at, because for me, it is important from a diversification standpoint to have that global perspective and to have that global diversification.
Yeah. And then we have, of course, also besides that, a few of the cheaters like Medtronic. Is Medtronic's now officially an Irish company, right? And then we have Chubb, the insurance company, Swiss
Yes.
at the moment.
And I own that company as well.
Yeah. And Apple is still American, right? It isn't Irish yet, I believe.
Not yet. Hey, look, I think that's a great way to leave the show. Ian, it's been an absolute pleasure to have you on. It's been fun for us, and I hope you've enjoyed it too.
Oh, absolutely. It is an honor and pleasure to be here. Thank you for having me back on the show, both of you. I really appreciate it. And to everyone listening in, thank you so much. And again, I do own the stocks I mentioned today, and in terms of a disclosure disclaimer, I don't offer investment advice. I'm just sharing my journey out there, and I wish all of you at home all of the best success on your own journeys with personal finance and investing.
Thank you, Ian. And hey, if you're listening still here, we will put all the links to social media from Ian as well in the description of this podcast, so that you can easily follow him on the social media platforms like Instagram, Twitter, and definitely also follow him on YouTube, like and subscribe. And of course, consider his Patreon to get even more insights about his dividend investing and overall, let's say, financial progress. Thank you, Ian, so much. As to Derek, it was a pleasure having you on. And yeah, let's see you around again.
Absolutely. Thank you so much. Have a wonderful day.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.